as a way to invest. If you're at all into technical analysis is a reaction to events.
Welcome back to the Money Seed Podcast. My guest today is Andrew Einhorn. Andrew is the CEO and co-founder of Levelfields. Levelfields uses AI to bring financial strategies to the masses. Andrew, welcome to the show.
Thanks for having me. Appreciate it.
In a nutshell, what is Levelfields AI?
So Levelfields AI, if you think about it as like your speed reader, it will automatically read 30,000 documents a minute, identify events that are proven to move share prices, flag those events for you, and then give you a forecast of how that event typically impacts share prices. So the goal of the system is to enable better decision making and to find trades and investments much faster than an average person could do on their own.
When you say that it's reading thousands of documents, like, is this scanning the internet all the time, trying to find the latest news articles?
It's looking at predominantly announcements directly from companies. So companies have to put out press releases, they do filings, they do earnings calls. So it's looking through all that information, and it's doing it at scale. So think about 6,300 stocks in the NYSE and the NASDAQ. You and I would need 200, 300 analysts just reading around the clock to identify, market moving bits of information, like events that are proven to move the needle. They could be catalyzing the stock for a day, or it could be a kind of a transformational event, like a new product being launched for a company that changes the trajectory of the company for the next several years. And so what typically happens is if you ask a person, hey, tell me 30 stocks off the top of your head, they'll probably struggle to name that many because we're conditioned to really think about the companies that are in the headlines all the time. The Apples, the Microsofts, the Teslas, the Nvidias. They generate a lot of buzz and clicks, and the media keeps pushing those same companies over and over and over again and talking about them. But they're not the only companies on the planet that exist. There's a lot of companies out there making money. And there's always some kind of bull run somewhere in some industry you probably never heard of. And so part of what we're trying to do with the platform is discover those types of runs, right? Discover those companies that are in transition that maybe weren't profitable and suddenly are profitable. Or maybe it was an industry that nobody thought of, and then a war breaks out and there is massive supply shortage of whatever they're putting out there, something like coal or sodium potash. How do you know? How do you find that kind of gem that's going to take advantage of some kind of macro tailwind? And the system's designed to do exactly that, to pour through unstructured text, right? Things that you and I would have to read paragraph after paragraph, looking for the little tiny little nugget, little piece of information that the CEO put in the press release that tells the story that, hey, leadership is really bullish on this company, so much so they're going to give a 8% special dividend this year. Well, how do you find those events? We've been conditioned to wait for the media to tell us, but the experience, I think, for most people is you wake up in the morning, you read the news, and sometimes there's a move of 30%, overnight or in the early hours, and you hear about it at lunch, and they're talking about this great move after the move has occurred. Not very helpful for most investors unless you want to jump on the high end of that, right? Your entry point becomes pretty much overbought. And so what we're trying to do is find that event before the media outlets even talk about it, if they talk about it, so that you have a chance to come in early and take advantage of that price move. And, most investors are looking for 7 to 10% a year if they're long holds. And our moves on average are about 7% in a day. So you could be done, with one trade for what you're trying to accomplish, sitting through the market, sitting through all the volatility, the public health crisis, the wars, the political changes, the upheavals. It's difficult to be a long-term investor in the environment that we're in. And so we try to give better decision making to kind of come in and out of the market, look for these opportunities that give outsized investment returns. And some of them can be, 100, 120% in a day or a week. These types of moves do happen. And while they're not frequent, like on a daily basis, they do definitely happen on a monthly basis. So you have a range of event types on the platform that you can look at and choose from. And you kind of pick and choose, just like you would scan for, flight deals and say, oh, okay, there's a deal going to Italy, there's a deal going to Arizona. We developed a system where you can scan for tradable events, and you can sign up for alerts where you can just log on to the application, kind of browse through and see if you find something you like.
So let's walk through an example. Let's say that we find out that a CEO is resigning from a big tech company, right? How would that actually play out on the system?
So you could log into the system, and if you were to look at the CEO departs scenario, you click one button and say, send me an alert, right? And immediately when that happens, the company will make an announcement of a leadership shift, and you'll be notified very quickly after they send the announcement in. On the system itself, we show the analytics of how that event typically plays out. And so you could see it's normally a bearish event, with a 2% drop on the first day of the announcement. And then you could expand on that view and see, over the next month, the stock may drop another 1.5. But then around the second month, there's a mean reversion, which means, it goes back to the original price. So the drop becomes temporary. The price reverts back to the original before the CEO departs. And what you actually see when you look at the analytics is a buying opportunity, not a worrisome event. You see a buying opportunity that, hey, companies of this size, they don't really need the CEO that badly. They're well established. Like when Jeff Bezos left Amazon, a lot of people sold, and Amazon price went down for a bit, and then it came back around about 3 months. And if you look over the prices, I think we just hit an all-time high, right? So you would have missed that opportunity if you didn't have the analytics to show how that normally plays out. And we make the analogy that we're kind of like a weather forecast for stock events, right? We can tell you what's going on in different parts of the country, the probability of rain, the chances of having, good snow, skiing weather over here, or whether or not there's a hurricane coming that's going to blast you for the next, week at a time. That's what the historical array of data is there to do. And we really want to eliminate opinion from the market because it's unfortunately pervasive. You can't turn to a news outlet without hearing someone's opinion of what's going to happen to the market, what's going to happen to stocks. And a lot of time that gets abused. People come in, manipulate, retail investors, and they come out and say, oh, you know what? Bank of America is bullish on this stock, right? Well, Bank of America might be bullish on that stock 3 months ago, but now they're offloading it and they need people to buy it. So they march them on television and they go and say, oh, this is a great stock. Well, you and I start buying it. They're selling it in the millions because it's going to take them a lot of buyers to buy off their, $30-40 million position. And that happens constantly. And we're kind of tired of watching that. And so we founded Levelfields on the premise that we can get rid of opinions. We can still find the information faster. We can allow the average person to monitor the market at scale the way large hedge funds can do, and to eliminate really the gap in technology and resources and education that exists between most individual investors and institutional investors on Wall Street that have access to more people and more technology.
So this sounds like for example, if I'm a user, right? If I'm a user of Levelfields, I would get an alert that said, hey, the CEO of this and this company is retiring. And then I would go into the system. The system would tell me historically what has happened is there's been a temporary drop for, let's say, for a month or two, the stock should go down. So then at that point, I would decide, okay, I'm going to sell the stock, see what happens for the next month or two. The stock takes a dip. And then as it's taking a dip, I would slowly maybe buy it back. And then I would kind of reestablish the position at a lower price.
That's right. You could certainly do that. We have some options traders that utilize a little bit more advanced strategies where, let's say there's a negative event like that they know is going to kind of come back. When the news hits, they'll sell put options, right? They'll take advantage of that premium that rises when people are like, oh, I'm going to short this stock because, Bezos left. So they're willing to pay twice as much for that option contract. And if you put a long enough date on it, and from our analytics that after about 3 months it comes back, you can say, I'm going to sell a put option with a 6 month from now expiration date. I'm going to make twice as much money on it. When the price comes back, I keep all the premium, with very little risk, right? That's one example. In other cases, you could actually manipulate the data. So we allow the system to be flexible. So you can look at that series of events of the CEO departs scenario, and you can add filters that we have on the system. So you can say, is this the same for large companies in tech as it is for small companies in biotech? And you could make that switch very fast, and you realize that the CEO departs of a small biotech, which is very much founder driven, usually scientists, that found these companies. It's a much larger decrease. 14, 50, 15% could be in a day. And likewise, for companies that are poor performing when the CEO departs, and they've, let's say, struggled, never been profitable, and their revenue growth is low, it's actually a positive event when that happens. The CEO departs, and the investors sort of rejoice and celebrate. They're like, oh, finally, get rid of this person. We got some hope and new blood coming in, and maybe they'll turn the company around. And you see these massive increases at that point, because the stock has usually been punished for years. And then all of a sudden, boom, it's up 30% in a day, on that announcement, and then continues to rise on the hope. And, you see that sometimes even with large companies like Disney. It happened when Bob Iger came back. The share price jumped. I remember the exact number, but, upwards of 10%. And then it continued to go, I think it was about $84 a share, and came close to about 100 just on the news of him returning. He didn't announce anything, nothing happened, but this is very much how the market plays out. It's sort of speculative, right? It's like someone else is coming in, they're going to improve the company. We see that with another event type that we track with our activist investor. Certain types of activists that come in, they buy a position of 5% or more in the company, can turn around the stock price pretty quickly. And what you usually see is a little bit of a jump on the first day, 3-4% increase. The real money comes from the next 6 to 12 months, where this activist comes in, and their entire focus, the only thing that they care about, is driving up the share price and returning money to shareholders. And so they're basically working for you, right? They're coming into the company, and they want to shed costs. So they want to sell assets, cut staff, and they want to do stock buybacks and dividend increases. And we saw the case with Salesforce at the end of 2022. They did this. Activist comes in, I think it was October. Share price had been in free fall in 2022, like most tech companies that were, either unprofitable or mildly profitable. And the activist buys in, and I think it was like $120 a share. First thing they do is they push for changes in the structuring of the company. So they fire like 10% of the workforce, right? Then they start to push out one of the two CEOs, because why do you need two CEOs when you can have one for the price of two? So there's easy savings right there. Then they fire some more people. Then they fire more people. And then as they're doing that, you see the share price going up and up and up. Because as they fire people, they're cutting costs, which means earnings are going up. The value of the company then becomes higher. So what do they do with all those savings after, firing, I don't know how many people, 10% of Salesforce is, but let's just say thousands, right? They take that and they say, you know what, we're going to do a $20 billion stock buyback. So we're going to take $20 billion worth of shares off the market, which makes the existing shares more valuable. And thus the share price goes from like 120 to 160 inside of, 6 months. And that's very much a pattern that we follow in kind of a longer term scenario. And it's a really easy one to buy in. As a user of the platform, all you simply do is you click a one button that says alert me when this event occurs. And the event occurs, you buy the same stock that these huge investors are buying, knowing that they're going to go and try to increase the value of the share price. And you just go along for the ride, and you hold on for 6 to 12 months. And if you are able to do long-term options trades, that could be 200-300% on your return.
Amazing. So we talked about, CEOs departing or activist investors joining. How many different types of events are you tracking?
Right now, there's 24. We're planning to launch more soon. And then we also have two different pricing tiers. So we have sort of the automated version of the platform where it's just completely do it yourself. In the back end, we're always sort of monitoring, testing different types of events and scenarios. We're looking at macro and micro types of events. And so in our kind of more premium subscription, we have analysts that actually look at other events that we're tracking, but we haven't actually rolled out onto the platform yet. And so those can see things like, how a war may be impacting a commodity price. And we will send out an alert. And it's in this form, we do it once a week, but it's like a human alert. It says, hey, the price of uranium is going up. Here's why. Most uranium comes from Kazakhstan. They can't get through the Suez Canal right now because, the rebel militants are firing at all the ships. So now they're going to go around Africa to get to Europe, which is going to take longer, which is going to be hit on supply, which means the price is going up. So you should buy the, uranium miners ETF, which we sent this alert out 2 weeks ago. It's up 16% since then. And just adding those two and two makes four types of things really matters. And so what we're trying to do is be able to monitor the market broadly at kind of the high level and then at the micro level. And hopefully we can continue to automate all of it. But right now, we're just trying to figure out, I think, the best way to integrate into the platform so it's not so overwhelming for people if we add those new events.
And your users, like how often do you think you need to be on the platform, or how quickly do you need to act on these alerts to make sure that it's working for you?
It varies. So there's different event types. Some move very fast. We have a share buyback event type that generally moves that day. And so I think the short version is if let's say the event occurs at 8 o'clock in the morning and the announcement goes out, it's going to move the share price all day, but generally by 1 or 2 in the afternoon, the price movement's done. Some of the other ones, whether it's increasing the dividend or activist shareholders, the moves are slower. And the reason is, it takes longer for people to find out about it. And it depends on the type of investor who's going to notice that bit of information. When you think about the market, you got to kind of divide it up into the different groups that are in the market, right? You have kind of the day trading, like some call it the pajama trading crowd, right? The sort of pre-market in their pajamas, wake up in the morning, 5 o'clock in the morning, and they try to make a couple trades before market open. And it's, in the pre-market where it's really volatile and trading is thin. So the price moves a lot. It doesn't necessarily mean that's what's going to happen during the day. You have the hedge fund crowd. Generally, they are not trading pre-market. They have to trade business hours because they need higher volume, given that the dollar figures that they're deploying are much larger. So you can't buy 3 million shares pre-market. It just doesn't exist. No one's selling that many. And so that ends up moving the price throughout the day. And then you have kind of the slow money is what I call it. Like the wealth managers, the asset managers, they're not on terminals every day, looking at this stuff. They're running stock screens maybe once a month, likely quarterly. They're making allocations with their capital slowly and have big positions. So they can't put 30, $40 million a day into the particular position. They have to do it over multiple days. And so by nature of that, the price moves slower for those types of events where, a company will go in like a Dix and they'll do 100% dividend increase. Well, that's going to get the attention of these sort of slow money over the next weeks, not days and not hours. That might be a little move. But, the larger money, the ones who are managing billions of dollars, they're not scrambling on a Bloomberg terminal to take advantage of that, right? So that gives a small investor a huge edge because you can move quickly. You can buy 100 shares at any time. You don't have to wait, days to deploy your capital like these large asset managers. So you can take advantage of that time and get in on it and then watch the share price go up and up and up and up. And you see that time and time again, particularly after earnings events as well. Whether a company has a great earnings report and you see there's a big spike and then it kind of calms down on day 2, and then day 3 starts a slow but steady increase over the next several weeks. And then the increase starts to draw media attention, and CNBC, they start hosting that as their, trade of the week or whatever that they do, lunchtime trade. And then it kind of takes a life of its own from there. The bloggers pick it up and it just goes, right? So in your question, you can choose to be daily. You could do one a month. You could do a couple a year. The price point of our application is so low that it's not an obstacle. It's a couple $100s a year subscription. So it should be one trade, one piece of information gets you that money back real fast. And if you find that you like going big or, making larger trades, then you can say, you know what, I'm just going to do like 1 or 2 of these activist events a year. And if I get a 50% return on each one and I trade options, then I should be at, 200% return. But we do have active investors who are, looking for 3 trades a week, I would say, 3 good ideas. We have others who are doing it more like algorithmically. So I know there's one, at least I've spoken with, who tries to get a 0.25 percentage point every day. And we have enough events where it's like, I can guarantee that the events that you put on the platform will drive at a 0.25 point a day. That's all I want. And at the end of the week, I've got my 1%. And then at the end of the month, I've got my 4.5%. And at the end of the year, I got my 50%. And so, everybody has a slightly different strategy. We have others who they use the platform more for, I would say, existing portfolio management, right? Maybe more defense. So let's say core holdings. They own Apple, Microsoft, Nvidia, Tesla, those types of stocks. And when an event happens, because they know what direction that event is going to go, they can then either protect their portfolio or look for ways to sort of buy more shares. So if a negative event happens and Tesla price drops, they could then buy more Tesla. Or for those who are a little bit more experienced traders, and they play with options, they'll use that as an opportunity and say, you know what, there's an event coming up. Tesla's announcing a new product launch. They look on the platform and say, most of the time, this doesn't go very well. If it's positive, it's like mildly positive. If it's negative, it's really negative. And so they say, well, I'm going to sell calls on my existing position. I'm going to sell options. And so if the share price does drop, then I can just buy that option that I sold for $10 back for $4. And I'll make $6, per contract times 100. So it's a $600 quick, profit without doing really any work. And I kind of wonder sometimes when I read, you run into these like blogs on Medium, and there's all this stuff on TikTok, like how to make an extra $400 or $500 a month by, drop shipping on Amazon. And here's the 17 steps that you need to do to set up your SEO and use, Chat GPT to write a website. And it's like, wow, that looks like a lot of work. I can just sell a call on like an existing position, and in about a day and 5 minutes worth of work, we get the same returns. So I highly encourage people to look at that before they invest the time in, coming up with their own product to sell on Amazon.
And how has the response been like? How long have you had this product on the market? How many users do you have today?
So we launched August 2022. Before that, we did about a year beta test, which was largely invitation only. We opened it up kind of at the tail end. And it was a small amount of users in the beta test that we interviewed. Since launch, it's been very, very rapid growth, 600% growth annually since the time that we launched it. Our next kind of target that we have in range is 10,000 users on the application. So we're pushing towards that. We found that the reception's great. Some of the feedback has been, this is awesome. I just need a little bit more training. Can you put some more educational videos on there so I know what I'm doing? And so that's largely what we're focused on right now, is sort of the onboarding experience for those that are less seasoned investors, less experienced. We find that if you've had like 3 to 8 years of experience, generally it's great. You come on there, you get it right away, you understand what we're doing, see it, like, wow, this is quite simple. I don't need to be a fundamental analysis person that knows how to analyze a stock's valuation. I don't need to be a technical analyst, looking at all these different patterns and shapes. I can just keep it very simple. Here's an event, it changes the share price. I'm just going to find these types of events, and when it moves the share price in the right direction, I can see my average hold time and I can see my expected return. And people really like that. It's sort of like common sense meets statistics, and without the opinion. We don't say, hey, we think this is going to be the next Amazon, and here's 5 stocks we like more than that, like all the marketing garbage you see out there. And we don't do that. It's just like, here's what the data shows.
And
it's main statistics.
And has the response mainly been from individual retail investors, or I mean, because this sounds like a great product that might be of interest to, say, institutions as well, right?
We have a lot of interest from individual investors, but we do have some institutional users that use it on a personal basis. At least that's what they've said. So, example, one user we had, and I saw, and sometimes we do reviews of feedback and kind of where people are coming from. So I saw they had a professional, email, and reached out during the beta test to find out why they were using the system. And so this person was a hedge fund advisor based in Singapore. And we got on the phone and we're doing sort of a Zoom conversation. I see it behind him, he's got like 6 of those big screens, all wired together, and clearly like a Bloomberg terminal on there. And I said to him, like, very plainly, like, look, why you're paying $30,000 a year for a Bloomberg terminal? Why are you using Levelfields? And he just turns, he's like, this thing takes forever. He's like, it just takes too damn long. He's like, I want to find something. It's somewhere in there, but it's like looking for, a needle in a stack of needles. He's like, your system, like, I click a button. If it saves me an hour a year, it's worth a $200 subscription. So I use it. And so we're sort of pushing more on that time savings view for, institutional folks that sometimes do this, sometimes not. Usually just the top hedge funds have really big event-driven sections, book runners of $1 billion or more that are doing event-driven strategies. And they're doing some of these things, and we're kind of taking some of those strategies and then allowing everybody else to have access to the same ones. And so we're democratizing that, where it would be difficult to do on your own otherwise. So we've had some hedge funds not so happy about that as we're pilfering their alpha, and they try to kind of spy and get little bits of information about, like, well, just how fast are you getting it? Can you send me a spreadsheet that analyzes all your trades over the last 3 years? And you kind of gauge whether there's legitimate interest in using the technology, or are they just worried that they're going to lose their edge in that particular event-driven strategy that they are deploying. And so that's been interesting. We also had a venture capital fund that was sort of feigned interest in investing, and then tried to like steal all the data so they could do trading on their own. So it's been a ride. You sort of know that when people are continually trying to steal your data, you must have pretty valuable information. Otherwise, why would they bother? So we kind of take that as a pat on the back, although it makes you a little more wary about who you do business with. And so our plan is sort of to continue with the individual investor, and at some point we will create a more kind of industry focused or professional grade tier with different types of tools that we found to be more like summarizations, right? Automatic reports, so they don't have to go and do all these different actions to analyze stocks. Like the typical pattern is, I'm going to go to Capital IQ, I'm going to run a stock screen, I'm going to get a list of results, I'm going to download those. Then I'm going to look at how they performed in, battle tested environments, like different time periods. They do all that on spreadsheets. Then they're going to write a summary about their thesis, and they're going to look at, here's my 30 of those, or the 30 stocks that I think we should be investing in. So we're going to automate that whole process. So that just becomes a couple clicks, and then you get that report, and that report can be delivered to you on a regular basis. And so that's what we think the more professional grade version will look like. And we've, on the back end, we have a lot of that in place. And then we'll continue to expand on the existing platforms so that there's more events, there's more variety, there's more ideas that might be, I would say, longer term and maybe simpler for some folks. Like, hey, just tell me a stock that does well every year for the last 10 years is a common request. And we're like, all right, yeah, that's easy to do with data. We can do that. That's not sophisticated, but those types of questions are largely unanswered unless, some blogger decides to write it. And then the second they write it, it becomes outdated going forward because the market's constantly changing. So unless they have a dynamic system that's monitoring all the time, the second things get published, it's done, like it's already outdated. And so that's been another challenge, I think, from being an investor. It's like when you want an answer to a question, you do a lot of Google searching, and sure, maybe now you can throw it into Chat GPT and speed up your Google search, but effectively it's still a Google search of what has already been out there and written. But you already have to have that thought. You have to know what you're looking for, and you have to hope that someone was kind enough to put the information out there for free, which is not always the case, or kind enough to put together a list that was accurate, which is very much not often the case because it's a lot of clickbait. They put together these articles like, here are the biggest dividend companies of 2023. And you look at them and you're like, no, they're not. These are the most commonly bought dividend companies of 2023, but they're not the biggest dividend companies. And there's a lot of misinformation out there that we just want to eliminate.
If I were to speculate, I would say that at some point in the future, you guys are probably going to open your own fund. Have you ever thought of basically open up your own fund and have Levelfields drive the decisions?
Every day. It's the short version. So we do trade. We do put our money where our mouth is, or at least where our AI is. And when we first started the company, we were building. We had no we had no users. We were just building and testing. And so, particularly for my role, where I'm kind of like more the architect, and then the engineers actually build the things that work, and they tell me where I might be wrong. There was a good period of time, of like 6 months, let's say, where I didn't have very much to do, like day-to-day work for the company because they were busy building. I had given the instructions, and so I just started using the platform to trade. And I've never done that well trading in my life. I made a ton of money, and I looked at it and said, you know what? If I could just make money off the system, I'll just put it back into the salaries of these folks that are building the platform. And that's exactly what I did. And so now, I still try to trade as much as I can. There's very little time in a day to do it, but I squeeze in probably 1 or 2 a week. And then in our level 2, or kind of more premium tier subscription, we track the recommendations that are sent out, right? The alerts. And we just hit, since we launched it, I think that was October 2022, the returns of the closed level 2 trades just hit 2,800% return cumulative.
Okay, whoa, say that again. Say that again slow.
So in a span of about a year, and so think about the membership, right? Every week we send 1 to 2 different premium, call them premium trades. It's like the human filtered AI trades. And we add kind of an entry and exit point for each. And then we track the performance of that. And so since we launched it, the returns has been 2,800% cumulatively for the, let's say, 50, 60 trades that we sent out. And that has sort of gotten a lot of attention from folks. where they're like, why don't you open your own fund? You should be, just bringing money on and so forth. And it's always been kind of aspirational that we want different opportunities for people. We want them to be able to, if they want to park their money with us, sure, we can do that. If they want to invest on their own, yes, they can do that. But everything takes time, and licenses from the SEC don't come easily, things like that. But this is sort of the easy way of doing it. Is we send out an alert, you trade on the information, and if you follow the guidance, you'd be up 28 times your capital. And you don't have to, unlike being a buy and hold investor where you're saying like, oh, to get, 28 times my capital, I have to put this big amount of money in and then just leave it there. Like, that's not actually how it works, because you get to exit and then take the same amount of money and then invest again and then take the same. So you could use smaller amounts of money, right, to get to the same outcome, because they're kind of coming in and out. You put $1,000 in the market and then you get two back, and you put $1,000 in and you get two back, and so forth. So that's a lot of it. And it's been pretty remarkable, actually, that kind of return. So we have a lot of advisors that are like, you need to start a fund, you need to start a fund immediately. And we're kind of just very, very busy, small group of people who are, doing what we can to keep the application great and scale it. But it's definitely in view to build that out in the future.
Those are some amazing numbers. Tell us a little bit more about the pricing. Are there different tiers? Is it a monthly fee, annual fee? What does the pricing look like?
Sure. So we set it up to be $228 a year, which breaks down to about $19 a month. It is an upfront cost. And the reason we do that is the second you log into the platform, you see the strategies. You see 24 event-driven strategies. You see the data. We don't want to have to hide it. And so there's a knowledge transfer, right? Like, you come in, you have answers to questions, and so we have to charge for that. Otherwise, we can come in, copy everything down and be like, okay, I've got it, right? And then done. And so that's part one of the service. Part two is obviously you can create these AI alerts, and you can customize those alerts. You can create watch lists, look at trends. The more premium subscription is $167 a month. That is monthly. And that gets you sort of that extra level. It's basically putting a human over the AI, because we send out on the platform about 4,000 alerts per year. The feedback that we got for some is that can be an overwhelming number. They don't know really where to pick and choose, like which event types to use. And so what we do is we include an hour of onboarding, onto the platform with that subscription. And then every week they get 1 to 2 kind of, almost think of it like the editor's picks, right? Of the AI alerts that are coming out, we flag the ones that are going to be most successful, most likely. And then also add, like, here's where you could look at an exit point, right? Based on the data. So it's just a little bit of interpretation. And we charge more for that because there's a human element to it. But the technology is doing the hard work, right? We're just kind of on the terminal, analyzing it and kind of summarizing it for folks. And so that, if you break it down, all right, you're looking at $40 a week on alerts that could be yielding 100% in a day, 200% in a year. We've seen some of the companies on that technology platform return 10x over several years, if you understand how to use the system properly. For example, if you look back, there's one company called, it was VRTV. It's the ticker, Veritiv. This is a product architecture, kind of like engineering. So their design packaging so that you could send a consumer product to someone's doorstep. So all that plastic wrap that it comes with, and like the design and layout of the box, that's what they do. They design that, they build it, and so you can ship it. And so if you look back in time, in March of 2020, when the whole market had sold off because COVID hit, and the market was down, 25%. And most oil companies are slashing their dividends, and companies are beginning to think about layoffs already. Businesses are shutting down because we're all going into lockdown mode. This company's buying back its stock, like a lot of it, saying, you know what, we have plenty of cash. We're not worried about COVID. We're going to buy back our shares because they've taken a huge dip. And if you saw that and you put that into context and said, the whole market is selling off and panicking and slashing and hoarding capital, except for this company, what makes them unique? Why are they buying back shares? And if you took 5 minutes to look at what they do, you would have the answer that every company that previously had sold big boxes of stuff to Walmart and Target and hoped that the retailers figured out how to distribute it to us consumers had to rethink how they're going to get their product to an individual. And now they got to bring it to your doorstep. Now they have to figure out direct to consumer method. And the biggest beneficiary of that is the packaging company that everybody goes to and says, oh, I got to design, something to get my iPhone to the front door. Can you guys do that? Absolutely. Business was booming. And so that stock from that moment was up 1,000% over the next year and a half to 2 years.
Incredible.
And it just transformed. And that's what we say, like events, they change everything. They change the trajectory of a company, positively or negatively, on a long-term basis and on a short-term basis.
That's incredible. Andrew, as we move to wrap up this interview, I'm really curious, can you offer our listeners and our viewers any tips, for example, on trading? Has there been any really big things that you've noticed on mistakes that people make in trading, or how has this improved your trading? Are there any quick tips you can offer?
The most common mistake I see, particularly with newer traders, is they try to trade pre-market, the after hours, where the volume is very thin. And it's so thin that sometimes it only takes a couple people to change the share price. So, for example, we see this happen a lot. Let's say there's a company that does a big stock buyback and they announce it, at 6 o'clock in the morning, right? So by 8 o'clock, you might see that stock price up 20%. And the buyback in value might be a 10% increase. And so if you look at it mathematically, you say they're buying back 10% of the company, the price should be up 10%, not 20%, right? Unless there's some longer term tailwind going on. And the reason why it goes up 20% is because I might say, you know what? Let's see what I can get for this. I'm going to put the stock out there for 20% more than what I own it for. And you, a new investor, might not care and just buy it. So now me selling it to you for 20% more, we just changed the price for everybody else's view. And then other investors will look at it and say, I missed it. I missed the move. And we go, you didn't miss the move. You missed that, I sold it to Gabe for 20% more. There's still another 10 million people that have to weigh in on what the share price should be. And over time, that price will get normalized. And so what you normally see is huge increase pre-market. And then let's say you bought it and you're like, okay, yeah, I bought it 20% up and it goes up another 5%. Everybody else who sees this says, well, if they're getting 20% premium on it, I'm selling my shares. As soon as the market opens, what happens to the share price? It goes straight down.
Yep.
Straight down. And then we have some users that will be like, oh, your system doesn't work because the price went straight down at the open. I'm like, you have to wait. Like it's not instantaneous pricing. These are actually people on the other end. And a person has a life, and that life might include taking care of their kids in the morning, walking their dog, commuting to work, getting to the office, getting that cup of coffee, having that first meeting, having that second meeting by the time they see the news. People are going to react at completely different time frames. So no, like the whole market doesn't react in the first 45 minutes of trading. It's bonkers. Like it goes on and on. And so what normally happens is you see this huge increase pre-market. Then it sells off at the open. It oversells. It sometimes goes lower than the original price it was before this event, which is ludicrous, right? Because it's a catalyst. So let's use real numbers. Say the stock goes from, $100 a share to 120. Then at the open, it might crash back down to like 102. That's your entry point at 10 o'clock in the morning. That's when you buy, not pre-market when there's no volume. And the people that do that are willing to wait that little jump, they're going to make a lot more money. And they're going to have less volatility. They're going to ride it from 100 back to 110, which should be the price if they're doing a 10% buyback, because that's 10% of the shares disappearing from the market, which makes the remaining shares about 10% more valuable. And that's it. Like those little bits of information, which, by the way, we include in our knowledge base for free on the application, you can use that and you can do it all day long, because that's unfortunately just people will trade just because they have the time at that moment, not necessarily it's the right timing in the market. And if you're patient and you understand the patterns of not just events, but of people who have time in the morning before work, a lunch break, and a little bit at the end of the day, those are like the big peaks and valleys of the day, you'll understand like why a stock goes up and down a little bit more during the day. And then you can see some of these patterns. So that's an easy one to correct. Another one might be, just looking at events in general as a way to invest. If you're at all into technical analysis is a reaction to events. That's what technical analysis is. So when you're looking at these wonderful patterns and you're like, oh, it double bottomed and then it jumped off, like most of the time it's because there was some kind of event that catalyzed it. It's not because it formed a pattern and then went. Sometimes that happens with the algo traders, but for the most part, when something breaks out of a pattern, like it's an event that causes it. So you don't actually need technical analysis if you track the events. It predates the pattern. So there's a lot, and I see a lot of information about how to interpret technical analysis, and just sort of wonder, like, it's nice, but those are not things that are actually moving the share price. Like the things that move the share price are the news, the event itself, and so that's where I would focus energy on. If you can combine, performance of a stock with an event, could be poor performance in an event or good performance in an event, you're going to see, outsized returns very, very, very quickly.
Andrew, I love the technology. I love the product. Where can people find out more, and where can people reach out to you?
Sure. Just go to Levelfields.ai. The idea is we're leveling the playing field between institutional investors and individual investors. So go to Levelfields.ai. You can sign up. You can look at a few of the demo videos we have on YouTube. You can use podcast 23 as a coupon code to get percentage off. So, if you listened all the way through and you're at the gym or you're doing laundry, just make a note, text yourself, email yourself, levelfields.ai. Even if this is not for you, I guarantee you know somebody that will benefit from the knowledge or, the trades that are on the platform itself.
Very cool. I'll put those links into the show notes. Andrew Einhorn, thank you very much for joining us today.
Thank you. Thank you for having me. Appreciate it. Good to talk to you.
Hey, thanks for joining us for another episode of the Money Seed Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.